Imagine a bakery renowned for its decadent chocolate cake. This bakery decides to share its success by offering ownership. They divide the cake into many small pieces, each representing a share of the bakery. These shares are then made available for purchase by anyone interested in owning a piece of this delicious enterprise. When you buy a share, you're buying a piece of the company's future. If the bakery thrives, your share becomes more desirable, increasing its value. Conversely, if the bakery falters, the value of your share might decrease. This constant fluctuation is the heartbeat of the stock market. Think of the stock market as a bustling marketplace. Instead of spices and textiles, this marketplace trades in shares of companies. From tech giants to retail chains, the stock market offers a diverse menu of investment options. Companies listed on the stock market aim to attract investors with their growth prospects. Navigating the stock market requires knowledge, prudence, and a keen understanding of market forces. This is where our journey begins, to demystify the world of stocks and equip you with the knowledge to navigate this exciting terrain. Let's go back to our bakery analogy. When you buy a share of a company, you're essentially buying a slice of that company's pie. You become a shareholder, a part owner of the business. As a shareholder, you have the potential to benefit from the company's profits, typically through dividends or stock price appreciation. Dividends are like the cherries on top of your slice of pie, a portion of the company's earnings distributed among shareholders. Stock price appreciation is like the entire pie, growing larger and more valuable. However, just as a bakery can experience setbacks, so too can companies face challenges that impact their profitability. This inherent risk is an integral part of the stock market. Now that you understand what it means to own a share, let's talk about how you actually buy and sell these pieces of the pie. The stock market is a bustling marketplace where buyers and sellers come together to trade shares of publicly listed companies. The stock market itself isn't a physical place, but rather a network of exchanges, like the New York Stock Exchange or the Nasdaq. These exchanges act as intermediaries, connecting buyers and sellers and facilitating the smooth flow of trades. When you decide to buy or sell shares, you typically do so through a brokerage account. Brokerage firms execute your orders to buy or sell shares at the prevailing market price. The price of a share at any given time is determined by supply and demand. Remember that the stock market is a dynamic and ever-changing environment. Share prices fluctuate constantly throughout the trading day, influenced by a myriad of factors. One of the primary drivers of stock prices is company performance. Beyond company-specific news, broader economic factors also play a significant role in shaping stock market sentiment. Interest rate changes, inflation, economic growth, and even geopolitical events can all influence investor confidence. Moreover, investor psychology can also move markets, creating waves of buying or selling. Imagine our bakery from before. It's consistently creating delicious treats, expanding to new locations, and becoming a household name. As its popularity and profits soar, so does the value of the bakery. When you buy shares in a company that performs well, the value of your shares typically increases. This increase in the value is known as capital appreciation. Let's say you bought a share of our hypothetical bakery for $50. As the bakery flourishes, demand for its shares increases and the stock price rises. This potential for capital appreciation is a primary motivator for many stock market investors. Remember those cherries on top of your slice of pie? In the world of stocks, those cherries are called dividends. Dividends are payments made by a company to its shareholders, typically out of its profits. Not all companies pay dividends, but many established and profitable companies choose to reward their shareholders with regular dividend payments. Dividends are typically paid out on a quarterly basis. The amount of the dividend is determined by the company's board of directors. These dividend payments can provide a steady stream of income for investors. Now, let's talk about the icing on the cake, the real magic of long-term investing: compound growth. Compound growth is the snowball effect of earning returns on your initial investment plus any accumulated earnings. Imagine you reinvest your dividends back into the bakery, buying more shares with the money you receive. Those additional shares then start earning dividends of their own, which you can reinvest to buy even more shares. This compounding effect can lead to exponential growth in your investment over time. The longer you stay invested, the more your returns compound, and the more your investment snowballs in value. This is why starting early and remaining invested for the long term is crucial for maximizing your potential returns in the stock market. Remember our bakery? What if a new competitor sets up shop across the street, offering even more delectable treats at lower prices? These unforeseen events could spell trouble for our once thriving bakery, and just like in the real world, businesses face risks that can impact their performance and consequently their stock prices. Just as easily as the value of your shares can rise, it can also fall. This decline in value is known as capital depreciation. This potential for loss is why it's crucial to approach stock market investing with a healthy dose of caution and a well-defined investment strategy. Understanding the risks involved and learning how to manage them is as important as identifying potential winners. In the stock market, as in life, unforeseen events can occur that are beyond our control. These external factors can significantly impact the performance of companies and the broader market as a whole. Economic recessions, for example, can lead to reduced consumer spending and business investment, negatively impacting corporate profits and stock prices. Geopolitical events such as wars or trade disputes can create uncertainty and volatility in the markets. Natural disasters can disrupt supply chains and damage infrastructure, affecting businesses in various sectors. These external factors highlight the importance of diversification in stock market investing. And investing in the stock market inherently involves risk. However, just as a skilled baker carefully selects ingredients and monitors the baking process to minimize the risk of a culinary disaster, savvy investors employ various strategies to manage their investment risks. One of the most effective risk management strategies is diversification. By spreading your investments across different companies, industries, and asset classes, you reduce the impact of any single investment performing poorly. Another crucial aspect of risk management is conducting thorough research before investing in any stock. Focus on identifying companies with solid fundamentals and growth potential, and hold your investments for the long haul, allowing compound growth to work its magic. Section 1. Diversification, not putting all your eggs in one basket. Remember the adage, don't put all your eggs in one basket? It's a fundamental principle of risk management, and it applies equally to the stock market. Diversification, in essence, is about spreading your investments across different assets to reduce the impact of any single investment performing poorly. Imagine our bakery decides to only bake chocolate cakes. While chocolate cake might be a crowd pleaser, what happens when a new health trend emerges and people suddenly crave carrot cake or fruit tarts? The bakery, solely reliant on its chocolate cake, could face declining sales and shrinking profits. Similarly, in the stock market, concentrating all your investments in one company, industry, or asset class exposes you to significant risk. If that company faces unexpected challenges, that industry undergoes disruption, or that asset class falls out of favor, your entire portfolio could suffer. Diversification helps mitigate this risk by spreading your investments across a range of assets. This doesn't guarantee profits or eliminate losses, but it can cushion the blow of any single investment performing poorly. If one stock in your portfolio declines in value, others may rise, offsetting the loss. Research, knowing your baker before buying the cake. Imagine walking into a bakery and randomly choosing a cake without even glancing at the ingredients or asking about the baker's experience. You might end up with a delicious treat, or you might encounter a soggy bottom or an overly sweet frosting. Investing in the stock market without conducting proper research is akin to this blind cake selection. Before investing in any company, it's crucial to understand what you're buying into. Just as you'd want to know about the bakery's reputation, ingredients, and baking process, you need to research the company's business model, financials, and growth prospects. Start by exploring the company's website, reading its annual reports, and analyzing its financial statements. Look for consistent profitability, strong revenue growth, and a healthy balance sheet. Delve into the company's management team, their experience and track record. Furthermore, research the company's industry, identifying potential growth drivers and competitive threats. Analyze the company's competitors, comparing their products, services, and market share. The more you know about a company and its operating environment, the better equipped you'll be to assess its investment potential. Patience letting your cake rise before taking a bite. Baking a delicious cake takes time. You can't rush the process, cranking up the oven temperature or impatiently slicing into the cake before it's fully baked. Similarly, investing in the stock market requires patience and a long-term perspective. The stock market is like a bustling bakery, with prices fluctuating constantly throughout the day, influenced by news, sentiment, and a myriad of other factors. Trying to time the market, buying low and selling high, is incredibly difficult even for seasoned professionals. Instead of trying to outsmart the market, focus on identifying companies with solid fundamentals, strong growth potential, and a competitive edge. Invest in these companies for the long term, allowing compound growth to work its magic. Remember, compound growth is like the yeast in our cake batter, slowly but surely causing the dough to rise. The longer you let your investments sit, the more time they have to compound, and the greater your potential returns. Avoid making impulsive decisions based on short-term market fluctuations. Stay focused on your long-term financial goals and let your investments bake patiently. As we've journeyed through the world of stocks using our bakery analogy, we've learned that investing in the stock market is like owning a slice of the action, a piece of the pie that represents ownership in a company. It's an opportunity to participate in the growth and success of businesses you believe in, sharing in their profits and potentially seeing your investment grow over time. We've explored the dynamics of the stock market, this bustling marketplace where buyers and sellers come together to trade shares of companies, driving prices up or down based on supply, demand, and a myriad of other factors. We've learned that stock prices, like the aroma of freshly baked goods, can be enticing but also volatile, influenced by company performance, economic indicators, and even investor sentiment. Remember those delicious dividends, those sweet rewards for owning a piece of the bakery. We've seen how dividends can provide a steady stream of income for investors, like a regular delivery of freshly baked cookies. And let's not forget the magic of compound growth, that snowball effect that can turn a small initial investment into a substantial sum over time. Just as a single slice of cake, when reinvested wisely, can lead to a whole cake and more. But just as a bakery faces risks, from burnt cakes to changing consumer taste, so too does the stock market present its share of uncertainties. We've discussed the importance of diversification, spreading your investments across different companies and industries to mitigate the impact of any single investment performing poorly. Navigating the stock market requires knowledge, prudence, and a long-term perspective. It's about understanding the risks involved and taking calculated steps to manage them, just as a skilled baker carefully selects ingredients and monitors the oven to create culinary masterpieces. Remember the importance of research, of knowing your baker before buying the cake. Thoroughly research any company before investing, understanding its business model, financials, and growth prospects. Analyze its competitive landscape, industry trends, and management team. And just as patience is key to baking a delicious cake, it's equally crucial in the stock market. Don't be swayed by short-term market fluctuations or the allure of quick riches. Instead, focus on identifying companies with solid fundamentals and hold your investments for the long haul, allowing compound growth to work its magic. Investing in the stock market can be a rewarding endeavor, offering the potential for growth, income, and participation in the success of innovative companies. By approaching it with knowledge, a well-defined strategy, and a long-term perspective, you can savor the rewards of this exciting and dynamic world.